Well, trading on Wall Street will soon get underway, reacting to the jobs data. So far, so good. The markets are up, the equity markets. Joining us now from Cincinnati with his take on which way the markets might break is Nicholas Sargen. He's the Chief Investment Advisor at Fort Washington Investment. Nick, it's been a while since we talked, I think. Maybe even before.
Yeah, it is.
Yeah, it's been months. Anyway, good to have you back. Okay, now as you see, this reaction, we're seeing this rally in the markets right now. Does this essentially give the bulls, more leg room to see a rally in this market longer term?
That's correct. Betty, when the week began, I've been in the camp that the economic expansion is gaining traction. But, we were discussing and said, hey, with the terrible weather, you've got to be prepared for some weaker data. And then, clearly this latest employment report and the trend in the last 3 months, flat, comes out better than expected. And then add on that the purchasing managers' surveys, both for the manufacturing and the service sector, and yesterday's chain store sales. So this is encouraging that the recovery is gaining traction.
Hey, Nick, it's Adam. Everything you just said, I'm so fired up, I want to go buy him this morning. I mean, that's all great news, isn't it?
Yeah, again, I don't want to overreact. I mean that I believe that it's an expansion that's spreading. It's still not as robust as the typical one. But that what I try to track is who's right, the optimists, the pessimists. Let's take the optimist case. If they're correct, we should be seeing net job creation this spring quarter, say about 100,000 workers per month on average. So what I would basically say versus the pessimists, so far the optimists are I think, more on the course.
100,000 a month, I'm told that would pretty much keep the jobless rate unchanged, at least for now, Nick. But given that, then, does that mean that you want to be cycling in or positioned in cyclical stocks for the next few months?
I would say that I still believe that there's opportunities in the cyclical arena, but in general, Betty, we're value investors, and we tend to take a longer-term view about where can we pay for. We don't have to pay a lot for future creation. I think the good news is listening to your commentary on the profits situation. I'm exactly in agreement. The margins have definitely improved significantly, and really the bottom line is, or the real issue is, when do I get top-line growth? If you can get that, you're going to have a tremendous leverage effect. And so I think it's still a whiles off, but I think at least the latest news is encouraging.
Nick, we're coming upon the one-year anniversary of the March 9th lows. Do you think markets have run too far, too fast? You're a value investor. Do you see a lot of value play still out there?
I'm worried that it did go. I think at any point there could be a correction, so that's a given. But I would say that the following, here's the biggest difference that I see. A year ago, every major economy was in deep recession. Every major country was stimulating like crazy. Today, there's much more variation, and I think that's made it more confusing. But the real growth engine, as we all know, is China and emerging Asia. And then the cabooses are Europe and Japan. And really, I think the U.S. is kind of in the middle zone. And, from that perspective, I think we're going to get more variation of returns across stock markets as economic performance and policies differ.
Okay. Nicholas, thanks so much for joining us. Nicholas Sargen, of Chief Investment Advisor of Fort Washington Investment.